Did you know paying yourself the one way from your LLC can cost you over $16,000 in taxes? Or doing it the right way can save you just as much? The way LLC owners pay themselves has just been transformed by the new One Big Beautiful Bill Act that was signed on July 4th of this year. Guys, it's not just an administrative task. It's one of the most strategic financial decisions you'll be making for your business, because if you get it right, you'll be itemizing your taxes and you'll be building wealth. But guess what? If you get it wrong, the IRS can be knocking at your door. That's why in this video, I'm going to break it down in 4 ways to pay yourself, and then how the new bill affects each one, and a step-by-step framework to find your perfect strategy. Hi, I'm Veronique, an accountant, a tax strategist, and a business coach. I'm always looking for ways to help you keep more money in your pocket. If you need help with tax planning, click the link in the description for your free consultation. Don't forget to subscribe to our channel and hit the notification so you can get notified every time we post a new video. Let's get started. Chapter 1, the 4 ways to pay yourself. But first, the IRS does not have a specific tax class for LLCs. You, as a business owner, get to choose how you want to be taxed. With option 1, you can select owner's draw. If you a single member LLC, automatically by default, you are a disregarded entity. All you need to do, you simply transfer money from your business account to your personal account. It's flexible, but the key, you are taxed on your total business profit, not just what you withdraw. But with option number 2, if you have more than one owner being an LLC, you are classified as a partnership by default. You can take distribution based on your ownership percentage, or you can set a salary regardless of your profit. But with option number 3, you can elect to be taxed as an S corporation. This is the Holy Grail of small business tax planning. What do I mean by that? Let's say you're an LLC with a profit of $200,000. As a regular LLC, you'll be paying over $30,000 just in self-employment tax. But if you elect the S corporation and you have a reasonable salary, for instance, $90,000, you're only paying $6,800 in taxes just on that salary. The rest of the profit is taken as a distribution. It's not just to self-employment tax. That's over $16,000 in tax saving. With option 4, the C corporation. As an owner, you get a salary and the remaining profits are paid as dividends. But there's a problem to that. The corporation pays tax on the profit, and then you pay tax again on the dividend. This is known as the double taxation. Let's dive to chapter 2, the new tax law game changer. The One Big Beautiful Bill Act has changed everything. For instance, the qualified business income QBI deduction, which allow most LLC to deduct 20% of their business income, is now made permanent. But there's a catch. W-2 wages you pay yourself from S corporation do not qualify for this deduction. Only the business profit do. Because of that, it adds a new layer to the salary versus distribution strategy. So let's go to chapter 3, a reasonable compensation rules. Being an S corporation with a strategy is very powerful, but you must pay yourself a reasonable compensation. I always want to know whether your salary is what a similar company will pay for your services in your specific industry and your exact location. This is how to protect yourself if you ever get audited. First of all, you're going to need to define your role in writing. Second, research comparable salary using legitimate sources. Third, document your decision-making process. And finally, renew it annually. Doing those steps is the only way to build a real audit defense. Now that you hear about the strategic steps to pay yourself as an LLC, what are you going to do? First, project your profit. If you're not making at least $60,000 to $80,000 in profit, S corporation might not be for you. Second, model the saving by running your numbers. Third, find out if your state is a static conformity state. Finally, factor in bonus depreciation and impact on your QBI deduction. Guys, the One Big Beautiful Bill Act has lots of great opportunities for LLC owners who understand the new landscape. But with the great opportunity comes great complexity. Remember this, QBI is permanent. S-Corps can save a fortune if done right. State conformity is a real risk. And perfect documentation is non-negotiable. The stakes are way too high to guess. The cost of getting it far exceeds the cost of hiring professional guidance. Don't try to handle those complex strategies alone. My challenge to you is to take action now. Drop a comment below with your biggest challenge with LLC compensation, or if you're ready to get started, click the link in the description to schedule your free consultation with us. Remember, don't leave money on the table.